G'day, I'm Patrick Lawler from Investec Wealth and Investment, and today we welcome into the studio Annelies Pierce, who works in our Swiss office. Good day, Annelies.
Thank you, Patrick.
Annelies, the UK voters have made their decision. They've decided to leave the EU. This has a lot of implications on the UK and its economy, and also in terms of what sort of deal it could structure. Let's talk about the impact on the UK economy, and also in terms of what sort of deal it might be able to negotiate with its trading partners, notably the rest of the EU.
First of all, the UK impact, I think we've seen the first bit of it. The currency has weakened dramatically. I think an outside systemic shock at a time when the growth rate wasn't strong worldwide, we've got weak growth rates, is not a good thing. That will probably put the UK economy in the near term into recession. I don't know if it will be a deep recession, but definitely into a recession. And then over time, hopefully the weak pound will help their exports and they will grow further. So yes, now that people are digesting the shock, we are now unfortunately in very uncertain territory. Until Cameron steps down, he said he will not invoke Article 50. So it means that the road to actual exit, which is 2 years, have been delayed. He's leaving that for the next Prime Minister. But there's a lot of uncertainty, and uncertainty is not good for markets, it's not good for consumer confidence, and we already have a problem that people are very risk averse and saving, and I think that will just be continued.
We've seen markets respond quite negatively to the news, but in many ways this also reveals some of the underlying cracks in the system that were there anyway. Let's talk a little bit about that, but then also maybe about the impact on the rest of the EU. Will other countries maybe follow suit with referenda of their own?
I think there's a lot of hype and a lot of discontent, because being in the EU has been difficult for countries like Italy and Spain and even Ireland. When they had crises, they had to readjust. They have to be very careful on bringing their budget deficits in line. So on the fiscal austerity has been very tough on them. However, they have had an advantage. Once they came into the EU, they had very low interest rates. So they had these economies that they could grow at very low interest rates. However, they didn't use that opportunity to restructure. And we now have seen the chickens come home to roost. Will EU break up? There will be a lot of doubt in this coming year and a lot of uncertainty. Eventually, I don't think the European Union will break up, because it's not just about currency union, it's also a political union. And if you look at the East Bloc countries, they are happy to be in Europe because in a way they protected from Russia. So geopolitically it's been stable. This has been a plan that's been in place for 46 years. The UK stepping out, I don't think will make a difference. There's been a lot of hype about the Netherlands and Finland and everybody else wanting to step out, but I do think ultimately they benefit a lot more by being part of this big bloc. You know, it's a proper trading bloc, you have free flow of people. In any case, it makes it easier, and it makes it a proper counterweight to the US and eventually China. So I think the UK has made a big mistake by stepping out. Unfortunately, there's a big anger vote that came out. And we will probably see a similar anger vote in the US when the elections come up in November.
Let's turn again to the markets. We've seen the safe haven assets such as gold, the US dollar, the Swiss franc, US treasuries, the Swiss franc, and of course German bunds and Swiss bonds. This could continue, but I suppose the other aspect we've got to look at is how this has maybe just revealed underlying cracks that were there anyway. Maybe we can talk a bit about that.
Even if Brexit didn't happen, we already saw the volatility in the run-up to Brexit, but it is highlighting underlying problems. If we look at growth momentum in the whole world on a global basis, that was doing well the beginning of this year because we had a lot of stimulation out of Europe and we've had stimulation out of China. Now those stimulatory impulses are busy falling away, and if we look at what's the growth numbers underneath, the US second quarter GDP came out at 1.5, I think, today. But that compares to 4% the second quarter last year. So we had a very weak first quarter, and the second quarter is not great either. So I think last year this time it was the first quarter was weak, the second quarter was growing at 4%. We're not going to get that. So ultimately the growth impulse is starting to slow down. Quantitative easing has been happening, but the US hiked interest rates. So in a way, there's a domino effect. Because they hiked interest rates, it did make the monetary conditions tighter. And I think that is probably at the time that we didn't need extra stress on the system. And Brexit shock now, unfortunately, is just pushing it further down. So I do think we're in for a very, very difficult year, because after Brexit, we still have the Italians to vote soon. I think that's in October. Greece has an election coming up, or voting again. And then in October, we also have the Chinese have their congressional meeting. And the current president have to show that he knows what he's doing. So he will also be balancing their very big debt versus the stimulation that has happened. So, as I say, life is not easy. We're sitting with aging population. We have very high debt levels and no growth.
Do you think there'll be a response from the central banks around the world?
There will be they are responding. They are keeping liquidity in the market. They're allowing a little bit of currency intervention. How much more can they do, given that they have done so much quantitative easing and it hasn't helped? I do think where we need governments to step in now. You need fiscal packages. You do need to have helicopter drops that everybody has been talking about, and we will probably see the one in Japan happening far sooner than we expected, because this very strong yen has been very bad for that economy.
Yeah, and I suppose for emerging markets it means just a little bit more volatility going forward.
Absolutely, and unfortunately for emerging markets we have a strong dollar again. So a strong dollar really puts pressure on the whole system, because a lot of the debt in the world is dollar denominated, and every time the dollar strengthens, the debt burden just becomes bigger. So I think we're in for a rocky ride this year.
In other words, lots of implications for the UK, for Europe, emerging markets, the US, just about everyone. And it's going to be an interesting couple of years ahead for us, which we'll watch with great interest. Thank you for joining us.